If you're an investor that is looking for exposure to the US stock market, then the traditional advice has always been to buy into an index fund which tracks the S&P 500. It's one of the most popular indexes in the world and a go-to staple for most investors. But what if I told you there was another potential alternative index that you might want to consider looking at for your own portfolio? This index also tracks the US stock market like the S&P 500, but has consistently outperformed it over the last 15 years or so. I'm talking about the NASDAQ 100 index. In this video, I'm going to do a bit of a deep dive into the two indices and look at whether the NASDAQ 100 is the new benchmark index when it comes to investing in the US stock market. So just for a bit of a recap, the S&P 500, if you don't know, is an index which tracks the largest 500 companies listed in the US stock exchange. And it's been in existence since 1928, so about 95 years. The index isn't a free-for-all, and to be included in the S&P 500, a company needs to meet certain criteria. There's a whole document on the S&P or Standard & Poor's website which outlines all of the eligibility criteria for prospective companies, which I won't cover in detail at the moment. Essentially, an eligible company must have a market cap of at least $12.7 billion, have the majority of its shares in public hands, and have been publicly listed for at least a year. Moving on to the NASDAQ 100 now, the NASDAQ is actually a US stock exchange based in New York, and it was the first ever electronic stock exchange that allowed investors to buy and sell stock on a computerized system without the need for a physical trading floor. While more than 3,300 companies trade publicly on the NASDAQ 100 tracks the largest non-financial companies listed on the NASDAQ stock market based on market capitalization. So the NASDAQ isn't just a technology index, it also includes biotech, healthcare, retail, and other sectors. Again, there is certain eligibility criteria to be met for the NASDAQ 100 company listings, but the companies don't need to be incorporated in the US. It's enough to be listed on the NASDAQ exchange itself. So just in outlining the basic functions of the two indices, we can already see that the S&P 500 is a little more balanced and diversified as it includes companies from all sectors without exclusion. Whereas the NASDAQ 100 is a little more niche in that it includes a smaller amount of companies concentrated on fewer sectors and actively excludes one major sector, the financials. With that said, it's easy to see why the S&P 500 is generally seen by many as a bellwether index, mostly representative of the US economy as a whole. But how has the more balanced and diversified index of the S&P 500 fared when it comes to performance and return on investment? As long-term investors, we want our money to work as hard as possible for us to offset dreaded inflation as a minimum, or at best just build long-term individual or generational wealth. Is the S&P 500 really helping us to achieve these goals, or is there a place for the NASDAQ 100 to provide better returns? So let's cut right to the chase then and take a look at how both the S&P 500 and NASDAQ 100 indices have performed over the last 5 to 15 years. Here's the S&P 500 in the yellow line, with the NASDAQ 100 shown by the blue line. You can see just over the last 5 years that the NASDAQ one has been a bit more volatile, has easily outperformed the S&P 500 by about 40%, so 51% versus about 89%, which is quite significant. Looking back over a slightly longer time period from 2008 to 2022, the NASDAQ 100 has outperformed the S&P 500 11 out of the last 14 calendar years. But what does that actually look like from a numerical viewpoint? So looking at some of the numbers, the cumulative return for the S&P 500 over the same time period was 232%, which is actually pretty decent. But when you compare it to the NASDAQ 100's cumulative return of 511%, over twice as much, the S&P 500 seems to pale in comparison. Now remember that cumulative returns are not really that important unless you decided to start investing into funds that track these indices in 2008 and consistently bought and held up until 2022. But when you look at the annualized return, the NASDAQ 100 has returned 13%, while the S&P 500 has an annualized return of 8.5%. That's not to say the S&P 500 is a paltry return on your investment. It's actually a pretty good return. Now let's have a bit of a nosy into the sectors that actually make up both indices and try to work out exactly what has led to the NASDAQ 100 outperforming the S&P 500. If we break down the sectors that actually make up both indices, we'll find that they both have technology as its top sector. Both the S&P 500 and the NASDAQ 100 have the highest weighting in the technology sector, but that's really where the similarities end. 55% of the NASDAQ 100 is weighted in technology companies compared to 26% in the S&P 500. So that's more than double the amount of holdings in the technology sector for NASDAQ. Now, the NASDAQ isn't just a technology index, it also has large holdings of 21% in the consumer discretionary sector. So it includes companies like eBay and PayPal, while the S&P 500 is lagging behind a bit at around 15% for this sector. There are also some other subtle differences when you look at healthcare, industrial, consumer staples, utilities. The S&P 500 usually holds more of these sectors within the index, but they are included in the NASDAQ 100 as well, just in smaller percentages. Less than 20% of the NASDAQ is made up of these four sectors, compared to around 35% for the S&P 500. So this essentially means that if healthcare and industrial companies are doing poorly, for example, they will impact the S&P 500 more than they would the NASDAQ 100. But inversely, the NASDAQ 100 is very heavily exposed to the technology sector, which, as we know, tends to comprise long-term growth positions. The expectation is that these companies will innovate and evolve to change the world, and with all that comes lots of growth and increased revenue over time. This is often the reason cited to avoid an index like the NASDAQ 100, because of the volatility experienced with growth companies. But in actual fact, the rolling volatility of the NASDAQ 100 has only been slightly more elevated compared to the S&P 500, only 2.3% higher between 2009 and 2022. I think one of the biggest reasons as to why the NASDAQ 100 has outperformed the S&P 500, aside from the increased exposure to technology companies, is the sectors it has zero exposure to. The NASDAQ 100 has no direct exposure to the financial sector. So, for example, when the banking sector took a bit of a nosedive after the Silicon Valley Bank collapse in March this year, the NASDAQ 100 was really well cushioned against the drop in bank stocks, which is still in recovery a few months later. What we also notice is that there's a clear difference between the number of companies that are tracked in each index, 500 in the S&P and 100 in the NASDAQ. Surely the more components within an index, the more opportunities there are to benefit from growth. More is better, right? So shouldn't 500 stocks beat 100? Well, the S&P 500 is a lot more diversified than the NASDAQ 100. And you might think that this is a good thing because we're often told that a diverse portfolio is key when it comes to investing in the stock market over the long term. So why in this case has a diverse index underperformed its less diverse rival? It could be argued that more diversification becomes counterproductive at some point, causing the lower returns and worse maximum losses. Diversification isn't really a mechanism used to maximize returns per se. Instead, it's a good way of reducing risk by smoothing out those returns in something as volatile as the stock market. So does diversification help maximize investment performance? Probably not directly, but it does help you ride the waves of the stock market and is definitely a better psychological decision rather than the best route for juicier returns. And that's not to say diversification is a bad thing at all.
Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice.
Definitely can't argue with the big dogs there. Kind of sticking with the diversification theme then, there's another less obvious reason why the NASDAQ 100 index has outperformed the trusty S&P 500. And that's because both indexes are market cap weighted. So market cap or capitalisation just means the market value of the company. And the term weighted in this context is the percentage allocation of a company within an index. So indexes can be unweighted, where each company is allocated an equal share, or weighted, where varying percentage allocations are given to certain companies, often based on their value or market cap. Anyway, both the indexes we're talking about are market cap weighted. So what that means is that each stock in the S&P 500 and NASDAQ 100 takes up an amount of space proportional to its market capitalization. So bigger market cap companies like Apple, Microsoft, Amazon will take up more space in both indices than companies with smaller market caps like Starbucks, for example. This is important because in having 5 times as many stocks in the S&P 500 than the NASDAQ 100, the largest company allocations in the S&P 500 are much smaller than the largest allocations in the NASDAQ 100. Just to illustrate the point, here a table showing the top 10 components of the S&P 500 on the left and the NASDAQ 100 on the right. This isn't the full list, obviously. I wouldn't be able to fit that on the slide. But as you can see, the highest market cap company, Apple, makes up about 7.5% of the S&P 500. But it's closer to 13% of the NASDAQ 100. The same goes for Microsoft, making up 6.6% in the S&P 500, but more than double the percentage within the NASDAQ 100. Again, Amazon is another example with around 2.7% in the S&P 500, but 6.3% in the NASDAQ 100. What you can also see as well is that the larger weightings in the S&P 500 tend to drop off quite quickly. So between Microsoft and Amazon, the percentage allocation drops from 6.6% right down to 2.7%. This means that any one of these companies can't really manipulate the index too much, except for Apple and Microsoft. The rest of the companies can't really have much of an impact on their own because their weightings are just too small and diluted. With the NASDAQ 100, over a quarter of the index is influenced by Apple and Microsoft, and after that, weight allocations tend to drop off more steadily, from 6%, 5%, then quite a few 3, 2, and 1 percentages, before you drop below 1% allocations. So you can really see how overall the NASDAQ 100 is a lot more concentrated in its positions when compared to the S&P 500. So because the S&P 500 holds way more stocks, there can only be a small number of winners over the long term that can actually impact the index enough to achieve better returns. Essentially, the large winning companies like your Apples, your Microsofts, Amazons, etc. are handcuffed in a more diverse index like the S&P 500 because they will only ever be allowed to take up a really small proportion of the index. So it's not surprising that the S&P 500 has underperformed an index like the NASDAQ 100, where the best performers have been allowed to grow and take up a much more larger proportion of the portfolio. Instead of the 5 best performing companies competing with 495 other stocks to fight their way to the top, they're only competing with 95 others in a smaller index. So if you're an index fund investor with US market exposure, obviously the S&P 500 has been the go-to index to track for quite some time. We really don't know what the future will hold when it comes to the stock market, and performances like those indicated by the NASDAQ 100 do single it out as a growth index, which has the potential to reap better rewards when invested over the long term. But investment performance often isn't the only factor you should be taking into account when deciding which index funds to invest in. And this is by no means financial advice. It all very much depends on your risk appetite, your investment goals, and your life situation. And there are many instances where the NASDAQ 100 just wouldn't appeal. As I alluded to earlier, the psychological impact of investing in a less diversified index like the NASDAQ 100 could be problematic for some people, whereas others might be willing to take on the risk to different extents, maybe even investing in both to avoid the FOMO effect, who knows. Similarly, some people might be nervous about having so much exposure to predominantly tech companies that may have already experienced their maximum growth potential for this cycle in a period of historically low interest rates, which have helped buoy their growth. Perhaps you're more comfortable with the mix of value and growth stocks the S&P 500 provides, compared with the growth-heavy stocks of the NASDAQ 100. Also, if you're a dividend investor and want to take a passive income from your investments now or in the near future, then the NASDAQ 100 might not be the best option. Growth companies don't tend to pay out high dividends, if they even pay a dividend at all, because Either they're not yet profitable or most of the profit is just reinvested back into the business. There are more companies in the S&P 500 that have reached the pinnacle of their growth stage. So for them, it makes more sense to distribute profits to shareholders through dividends, like Coca-Cola and McDonald's, for example. Another really important point you might want to consider is the fees. So if you're not aware, you can't just invest into the NASDAQ 100 or S&P 500 indexes directly. The easiest and most popular way to invest in these is via a tracker fund, usually an ETF or an index tracker fund, which are passive investments that mirror the indices, so you don't have to go in and buy shares in every single company yourself. What you'll find is that ETFs which track the NASDAQ 100 tend to be more expensive. They have an expense ratio of between 0.2 and 0.33% per year. So for every £1,000 or dollars invested, you'll pay between £2 and £3.30, or the same in dollars. Compared to the cost of a standard S&P 500 ETF, this could be about 4 times more expensive. Not a huge amount when compared to the potential long-term returns, but still a consideration to take into account. Personally, I invest in both the S&P 500 and the NASDAQ 100 at the moment to try and get the best of both worlds when it comes to value and growth stocks. Even though there's some overlap with some of the tech giants like Apple and Microsoft, they do differ in other ways. In a future video, I'll be looking at the best ETFs on the market for exposure to the NASDAQ 100 index. So if that's something you're interested in, consider subscribing so you can catch that video when it comes out. In the meantime, let me know in the comments, are you heavily invested in the S&P 500, or do you only have exposure to the NASDAQ 100 or some other index that tracks the US? Would you consider blending the two, or even perhaps getting rid of the S&P 500 altogether and replacing it with the NASDAQ 100? I'd be really keen to find out, so let me know in the comments below. Thanks so much for watching, and I will see you in the next video.